is doing well today. My name is Frank Barbera, and we're going to get the webinar off the ground here in just a moment. We're dealing with a nice wet day here in Southern California. We've had a couple heavy days of rain, and all right, and we've got everything pretty much ready to go. It's been raining in the markets a little bit lately as well. We've seen the S&P down pretty sharply over the last few days, and the energy price, the oil price, has been declining precipitously. As we speak, the S&P is up about $7 at 1997, and the oil price is rebounding. It looks like we might be looking at the beginning of some key reversal days in those markets. So hopefully maybe the markets are near some kind of an important short-term low. At any rate, in this webinar, we are going to take sort of the view from 30,000 feet of the global economy. And I'll just start out by pointing out the nature of the recovery here in the U.S. This chart goes back to 1790, and what we're looking at is the annual GDP growth. And the little dash dotted line you see on the bottom, the right side of the chart, goes back to the 1970s. And you can just see that over time, the growth rate on the U.S. has been moderating. 0 is the horizontal middle line, and 5% is the first rung up. Right now, we're right in between that at about a 2.5% growth rate. We had a negative first quarter GDP, down about minus 3.5% in the first quarter, and GDP growth has rebounded subsequently with inventory bills bringing us back up to around 4%. But when you really net it all out, the net is about a 2.5% growth rate. When you hear the headlines, we hear about a recovery. Unfortunately, that recovery has been one of the weakest recoveries in U.S. history. I like to say that it's almost like the alternate universe. There was a Star Trek episode in the 1960s. It was called Mirror, Mirror, where the ship encountered an alternate universe, and every person on the ship had sort of an evil counterpart. And the evil Mr. Spock had a beard, and there was this very sharp contrast between the good and the bad in the episode. And in this recovery, we have seen this very sharp contrast. We have seen the stock market advance, spearheaded by firms with weak balance sheets. We have seen companies with high-quality balance sheets lagging behind. We've seen a recovery where the number of people on food stamps year after year, quarter after quarter, has continued to move up, where the number of people looking at social benefits, going on social benefits such as disability, has moved to new all-time highs, and where the number of people in the New York City shelter system, homeless, has continued to move up month after month, quarter after quarter. No sign of an improving economy there. At the same time, back to the world of contrasts, we also see the high end doing very well with record luxury car sales of Jaguar, Mercedes, Maserati, Rolls-Royce, BMW, Porsche, Lexus, and even Ferrari. And Ferrari has had record sales each quarter this year. So you see this huge disparity between the world of the haves and the have-nots. We can see CEO pay at 500 times the average worker pay. And this is the top 1% income has gone from 1979, $500,000, to I'm sure what is now well over $2 million. If this chart is through 2007, but if we were updating, it's probably well over $2 million now. And whereas the top 20%, second 20%, third 20%, fourth 20%, fifth 20%, these have all moved almost horizontal. So the outsized portion of income gains has really gone to the high end. And the United States has never seen a recovery with this kind of bifurcation, where you have this sharp polarity in income. And you can even see it manifest in the stock market, where the companies that sell to the high end have done quite well, and the companies that sell to Main Street have struggled. J.C. Penney has actually struggled just to stay in business, while Macy's is largely vacant. Walmart has struggled mightily, and so has Kohl's and Dillard's. So you can see this very sharp contrast, and that's the world we live in. Not a great place to be at the moment if your income is not moving up, and it has been a tough slog for a lot of families. Median household income has stayed at $55,000 on balance over the last 30 years, and that's put a lot of average middle-class families under stress. So we're going to just take a little forward view now of where are we going, and we'll take a quick trip around the world. And one thing, we'll start in China. China is slowing. You can see, for example, that basically housing is leading the decline in China. Residential land sales are down just over 50% in the last 12 months. In China, the manufacturing base is slowing. Forward growth estimates are coming down. The government is talking about a slowdown to 7.2%, which is a little laughable because those numbers are very high. And really, more likely, it would be shocking if China is really growing even 5%. But China's growth rate numbers have always been highly inflated, even back when they were 12 to 14% just a few years ago, and 7% has been considered the threshold for a recession. Private sector data suggests that those numbers are rosy. When you look at empirical private sector data, right now power consumption is falling and coal prices are collapsing. Why does that have anything to do with the price of eggs? Well, in China, 70% of the electricity is generated using coal, the electricity that runs the manufacturing base. And so with coal prices slumping, it's a sign that final demand is very weak. We also see a property bust developing in China. This is sort of the Chinese version of Case-Shiller from the National Bureau of Statistics in China, their whole housing price index, and that shows that prices now are moving into negative on a trailing 12-month rate of change basis. So we see declining home prices. The slowdown in general is deepening. Credit growth in China weakened last month, adding to signs that the world's second largest economy slowed further in the latest quarter. That's a headline from Bloomberg mid-November. The evidence adds concern that outside the U.S., which is sort of the cleanest dirty shirt in the wash, the global economic outlook is deteriorating. Chinese banks, the bad loans are rising. Not a big surprise here in the sense that we have seen a lot of subprime lending taking place, no money down lending in China, and that stoked the big housing price advance. But now we're seeing prices down 6 months in a row, broadly falling in 67 of 70 cities. Some places prices are down 10 to 15%. Even in Beijing, we just saw the first annual decline of 1.3% year over year. And again, we hear about miracles in economics, the Chinese economic miracle. There's some truth to that, but there's also, when you hear talk of miracles, also be aware of the fact that sometimes the miracle is really cheap credit and highly leveraged finance. And so that seems to be what is contributing to the slowdown in China now, the fact that they did a lot of subprime lending, and just like the U.S. did in 2005, 2006, 2007, and we all know how that one ended. So not only is China slowing, but when we move through Asia, Japan is also weak. Japan just recently, again, this would be about mid-November, November 17th, they announced their third quarter GDP, which unexpectedly put the world's third largest economy back into recession. We saw a 1.6% decline in the third quarter. That on top of a 6.7% decline, yes, 6.7% decline in the second quarter. Japan's GDP is now contracting at a 7.7% annualized rate of change. That's quite a whopping recession. And Mr. Abe, amazingly, just won re-election, but his cheap yen quantitative easing policy does not seem to be working. It seems to be raising import prices rather sharply and cutting into consumer spending, and also cutting into corporations and their willingness to have capex spending. So it seems like Japan, which is now in the 5th recession of the last 10 years, just doesn't seem to be able to figure out how to get out from the grip of deflation, and the quantitative easing certainly doesn't seem to be working. Back to China for just a second. Another sort of empirical data point would be steel production in China, which is also back to 2008 levels. If this doesn't speak to an economic slowdown, quite honestly, I don't know what would. Bottom line, when we look at Asia, disinflation is steadily becoming more entrenched throughout Asia, creating economic headwinds and making it tougher for governments to control debt. That is what a team from Morgan Stanley Asia recently said. They also pointed out that China, South Korea, Thailand, Taiwan are among 7 of the major 10 economies that are now experiencing producer price deflation, reflecting a loss of corporate pricing power and weaker commodity prices. Our overview right now for Asia is slowing growth. And when we move to Europe, not too surprising, these are tightly joined at the hip. 25% of what Asia produces is exported to Europe. Europe seems to be moving back into the heart of the hurricane. It's been sitting in the eye of the storm for a while, but we seem to be moving back into troubled waters. Eurozone GDP growth is now turning negative. That's from Eurostat. Italy is back in recession. This is their Purchasing Managers Index, which is back to negative. France is just tap dancing right on the brink of another recession. And French profitability is hitting record lows, while bankruptcies remain near record highs. No surprise that President Hollande has a 12% approval rating. That's the lowest in French history, so that's quite a feat even for a French president. Germany is slowing down, and we see PMI heading towards 50, which is the dividing line between expansion and contraction. And within Germany, a whole series of data points across the board: industrial production, factory orders, new orders, business confidence. These have all been quite weak over the last few months. Bottom line, when we look at Europe, this is the most important chart you'll see today. And what we basically have here is the CPI is heading towards 0. This is the consumer price index for all of Europe. I apologize, my little dotted horizontal line, which was supposed to be set on 0, somehow got moved a little lower. But where you see this low towards the bottom right side of the chart, that is just under 0, and we're rapidly approaching that line. That means that Europe as a continent is really skirting the edge of outright deflation. And deflation can be very problematic once it's entrenched. Once you get into it, it's very difficult to get out of. Bond markets as an asset class are usually very sophisticated in terms of rating what's going on in the real world economy. And here we see a big vote of concern being voiced by the German bond market. The bottom graph, the bottom line, is the Japanese 5-year bond yield. And Japan has been mired in deflation for 20 years. The blue line is the German 5-year bond yield. And a little bit earlier this year, the second lower high on the left side of the chart is essentially 0.92%. Earlier this year, the German 5-year bond was yielding 0.92%, and that's what you're looking at here is a chart of yields. And during the course of 2014, yields in Germany have collapsed down to 0.12%. Yes, that's right. You get 1/8 of an interest rate percentage point on your money in Germany, whole 12 basis points. But the German yields have collapsed and converged with Japanese yields, and that really speaks to the deflation taking control in Europe. The bond market is saying that perhaps the politicians are just running out of runway and time to alter course and avoid deflation. And we are seeing many interesting things taking place on peripheral spreads. This chart is not up to date. I apologize for it, but I'm going to get a new one for you guys real soon. It does show the last few years' worth of data, and it's enough to make the point. The bottom line is Germany and its yield, the low yielding German bond market. The top line is Greece, and then we have Portugal, Italy, Spain, Ireland, some of the troubled peripheral countries. And what we are seeing now, 2 years ago, when Greece was really in the frying pan and everyone was worried about Greece leaving the euro, Dr. Draghi, Mario Draghi, stepped up from Goldman Sachs, took control of the ECB, and said, hey, we will do whatever it takes to make these bonds money good. I have a big bazooka, which is the outright monetary transactions program, European QE. And we, the ECB, he said to the leveraged speculative community, we will backstop these bonds and make them money good. So if you were a hedge fund with a 35% Greek bond, he basically said, come on in and buy this bond, and we'll make sure you don't lose all your money. We'll stand behind you. We will be the backstop bid of last resort. And so trillions of dollars piled into European high-yield debt, and yields collapsed, and the spreads have narrowed. That's the spread between peripheral debt and Germany. And the market believed him, and they took Dr. Draghi at his word. Now we flash forward 2 years to where we are today, and things are not looking quite so rosy. We have Greece basically back in distress. Greek bond yields just hit a 1-year high. Spreads are widening out. Syriza, there's an election coming up in January where the Syriza party, which is basically saying default on the debt, looks likely to win. And so Greece is very likely to move right back into the heart of the turmoil and the storm come early next year. And so are a number of these other countries. Eastern Europe, there are a number of countries that look like they're in big trouble. So worse, it's becoming very clear that within Europe, not only is there a very big debt problem, the debt to GDP ratios for a number of these countries are still making record highs, but confidence is falling in the leadership, basically because Germany does not want to do quantitative easing. And this gets back to Germany and its 1920s Weimar inflation experience. The Germans do not believe in dealing with a debt problem by inflating their way out of it. Instead, they believe in austerity, and they believe that if you're going to have a debt problem, the way to do it is by spending less and balancing a budget and living within your means, which is incredibly sensible. But 57% right now believe that Germany is forcing a fiscal policy upon Europe that is too restrictive and too austere. And this is causing support for Europe's economic leaders to fall. This is Dr. Draghi and Mrs. Merkel, and you see the opinion polls in just the last 2-3 months have been tumbling. It seems like a lot of people are beginning to feel like the ECB measures are coming up too little, too late. And at the center of the storm is really a fundamental clash developing between the ECB and the German Bundesbank, between Mario Draghi, who heads the ECB, and Jens Weidmann, who is the head of the German Bundesbank. And Dr. Weidmann and several other heavyweight German ex-central bankers, Axel Weber among them, have come out very strongly recently to say the ECB would encourage Eurozone states to pile up even more debt if it were to buy state bonds, as well as legal limits, which is the reference to the ECB charter. The buying of state bonds would create wrong incentives, in particular encouraging indebtedness of Eurozone countries. This was Mr. Weidmann about 2 weeks ago. He went on. It has been said that the Bundesbank is quietly seeking legal advice right now on whether it can block full-scale QE, looking at the let-out clauses of Article 10.3 and 32 of the ECB statutes. Just recently, Dr. Draghi lost a major vote and control of a powerful board which he was on in terms of setting monetary policy. And so it now is beginning to look like Dr. Draghi does not have enough political capital left to bring on a European QE. What's more, Germany may understand, to take the positive side, let's even say for a second that Germany understands that in order to avoid outright deflation, Germany needs to have quantitative easing, because Germany is fairly all in on the European debt crisis problem. Probably very few countries have more to gain or lose than Germany. But Mrs. Merkel is in a position where she cannot go back to the German people and tell them, listen, I want to socialize $5 trillion worth of Greek, Spanish, Irish, and Italian debt and raise your taxes dramatically without having something to give them. And what she's going to need to give them is essentially a new structure coming from these countries, places like France, places like Spain, places like Italy, where they willingly hand over a very large portion of their sovereign decision-making to set a budget. If this goes now to a committee that is dominated by Germany and Scandinavia, basically if those countries are willing to hand over a big chunk of their sovereign decision-making, that's what she can then go with to say, okay, we'll do some QE. But that, just picture that battle between France and Germany, France handing over its budgetary spending to German politicians, or Greece doing the same. This is not going to happen quickly. And what it really amounts to, this standoff, is a standoff that's going to create enormous uncertainty. And uncertainty is toxic for equity markets. I like to make the analogy between the Bush-Gore election back in 2001, 2000, when we had the hanging chads, and nobody knew the next day who the president was going to be. I walked into my hedge fund that day. I was talking with a partner at the firm, and I didn't think it was that negative. My partner thought it was terrible, and he had a good 20 years on me. And I said, what was wrong? And he said this is awful. He said, this is awful. And he said, we don't know who the president is going to be. This is going to be huge uncertainty. The lawyers are going to get involved. It's going to go to the Supreme Court. It's going to hang over the market. And hang over the market it did. The market just withered away month after month. And my buddy Jerry was dead right. And this is the same sort of setup that we see here in Europe. This statute, this clash between the Bundesbank and the ECB is something that all of you should be paying close attention to. Turning to the United States, so bottom line, Europe and Asia both very weak, both heading towards contraction. The USA, again, muddle through economy, much better. We have recovered. The little dots on this chart show the job losses during the last recession and the recovery since, back to break even. But the solid line shows the full-time job losses. And what you see is that the full-time jobs have not recovered. We lost 8.8 million jobs in the last recession. We have gained 9.9 million jobs back. That's a net 1.1 million jobs created. Problem, though, quantitatively we've added jobs, but qualitatively we're adding very poor quality jobs. We've been adding McDonald's-type, low-skill, low-wage jobs. The current expansion is still lagging behind dramatically the average of the last 6 expansions. So this is a very poor quality recovery in the United States. And when you look at this next graph, the bottom graph curve shows those job losses and now the 1.1 million that we've gained back. But the government has also been doing a great job lying to the American people. Because about 5 years ago when this major crisis hit it, not only did they suspend mark-to-market accounting rules to enable the banks to survive, which they've never reinstated, by the way, but they also rejiggered the unemployment matrix. So today, if you're unemployed, you're not just unemployed. You can be unemployed. We have 9.9 million people who we call unemployed. But we also have a 13.3 million other people who the government has reallocated into new buckets that aren't really, quote, unemployed. You can be long-term unemployed. There's 3.3 million of those. You can be involuntarily part-time. That's 7.1. You can be marginally attached, whatever that is. That's 2.2 million. And you can be discouraged and given up. There's another 0.7. Well, all of these people are essentially underemployed. And that's 13.3 million people. Now, if we add those 13.3 million people back into the labor force, all of a sudden this rosy economic recovery, which is seen in the unemployment rate, come from 10% all the way down to 5.8%. Well, if we add those people back, well, the unemployment rate doesn't come down. It actually stays well above 10%. And as we all know, there are even broader measures, U6, which is at 16%. So depending on how you want to look at it, the unemployment rate and the recovery has been almost a phantom, a mirage for many people. This is why disposable income has not recovered much, why retail sales have remained tepid, why final sales have been very weak, and average hourly incomes have failed to bounce. For a lot of families, income growth is just not happening, and rents are moving up. That has been squeezing income. So there's been really a lot of negative things taking place, and this is why the economy is struggling. I would also add that the quantitative easing policy of the last few years has been essentially an IV for the banks. The banks have been taking all the money that's on deposit with them. When you go in and visit your money at Wells Fargo, Bank of America, or Chase, you're getting paid 3/8 of a percentage point, and they're just taking your money and investing it in bonds at 3 or 4%. And so they've been earning a positive carry every quarter. And they've been applying that carry to the cumulative $10 trillion losses, which they piled up between 2006 and 2008 in the securitization subprime fiasco. So this has been basically a workout for the banks, where they've had a risk-free profit guaranteed every quarter, and where they've been told don't make any more loans. This is why velocity and the money multiplier have collapsed, and it's come on the back of the American people, where, who has paid for it? It has been paid for by the American retiree. Mom and dad's risk-free 5-year CD earning 4% has been taken away. by the Fed, and that interest income that mom and dad should have earned without, taking any risk has been given to the banks. In fact, the transfer amount of money from American retirees' lost interest income to the welfare of Chase, BofA, and Wells Fargo cumulatively over the last few years now totals about $5.3 trillion, which is about half of the $10 trillion that they actually lost. So when you think about who's benefited and who's lost and probably who should have gone to jail, there's probably a few bankers out there who should be behind bars, right? Anyway, we'll just move along. The global economics, pardon the rant, that's my rant for the day. Couldn't help it. The global economic pie is shrinking. When we look at GDP estimates, they've been coming sequentially down. We feel like right now, as ugly as all of this information is that I'm sharing with you, and I take no pleasure in sharing any of it with you, because I would much rather the data looked a lot more positive. You have to understand that from a fixed income perspective, bonds have a ghoulish personality. The stock market does not like recessions. The stock market does not like slow periods of growth. The stock market has a bullish personality. It likes to see growth. It likes to see profits expanding. Bonds, on the other hand, have a ghoulish personality. They love recessions, and they love slow growth. During periods of slow growth, interest rates, the cost of money, the demand for money fall, and bond prices tend to do well. So when we were looking at Treasury bonds at the end of last year, the long-term bond was down 17%. Nobody really wanted to touch it. We decided this was a great place to be because we really didn't see the income growth that was going to, quote, bring on a strong economic recovery. That trade has worked out very nicely for us this year, along with trades in high-yield munis and other forms of high-grade corporate bonds. Long-term, there are a lot of folks out there worried about a bond bubble, and they were expressing that fear last year during the taper tantrum. But if you looked at it last year, yields never moved through long-term moving averages. They never broke out of long-term declining tops lines in their channels, the falling channels. And so we never really saw a strong technical indication that the bond market was fundamentally changing direction. And so we were big bond buyers. That's one reason Sierra's had a good year this year. And moving forward, when you look at rates, when you look at wages, and you look at economic growth over a very long period of time, this is from the 1950s to present, what you find is that you need economic growth accelerating from 3 to 4 to 5% and wages picking up to generate inflation, to generate higher rates. And right now, just none of that is happening. And that's been a core view of ours for quite some time. And we don't expect that to change. We think that interest rates are going to move down towards 2% over the next few months and possibly make new record lows over the next 12 months. So we think that while there's a lot of bad news in the economic data out there, that's actually good news for your fixed income portfolios. And we would suggest that if you have money in bonds, stay the course, steady as she goes with the bond market. And we see a lot of opportunity in the bond market to continue to make good, solid, low-risk returns. Now, in sum, I would quote Christine Lagarde. The IMF downgraded the global economic outlook in June. She then updated it in October and downgraded it again. And you see this very sharp contrast between falling world GDP and rising U.S. equity prices and other equity prices. And what Mrs. Lagarde said as recently as October, I think she really nailed it. She said there's a huge disconnect between markets and the economy, between essentially Wall Street and Main Street, that is quite worrying. She said the Fed's QE policy has not done much to aid economic recovery. that the global recovery is brittle, uneven, and beset by risks, and that the world economy needs bold moves to avoid a new mediocre. And I think one thing we can say right now is it does not seem like we're getting the bold leadership. Dr. Draghi, the rumor there is that he may be leaving the ECB very soon to move back to Italy to become president of Italy. And so not having the ability to force through quantitative easing may mean that he leaves. And at that point, this is a high and very key risk factor, because one of the things that has a big, big piece of what has kept the equity markets up has been confidence in the central bank put. It was the Greenspan put, it was the Bernanke put, and now they're talking about the Yellen put, but the credibility of central banks is the backstop of last resort. And when Dr. Draghi said we will do whatever it takes to make things okay, to turn out okay, he put their credibility on the line. And now it's beginning to look like the problems are coming back, and there may not be that deep well of central bank credit to reach into to continue propping things up. And if that's the case, then the markets will have to stand on their own 2 feet. And very high price earnings multiples, that may be a high wire act that the markets are just not capable of sustaining. We would suggest that when you look at crude oil right now and the incredible plunge, which this chart is also, I apologize, a little dated, but we've seen crude oil prices collapse literally over the last few weeks, that this is a manifestation of weak final demand in the global economy. There may also be geopolitical factors. I'll concede that. But I think fundamentally oil is trading where it is because basically final demand is weakening. Copper is also dropping sharply. Iron ore is down 50%. Brazil, emerging market currencies are in a crisis. And we've seen Baltic dry index rates collapse, measurement of freight activity. All of these things point to a slowdown. Tip spreads also narrowing point to a slowdown. That's an absence of rising inflation pressure, or if you want, an increase in deflationary pressures. And finally, a strong dollar. Often what you see is something that presages a recession. And so when you look at all these symptoms, it's really basically very, very clear that we are in an environment right now where inflation is falling, global growth is slowing, and tepid at best. This is fundamentally a good climate for bonds. And we think equities probably still have a little further to go on the upside. But I would say, as it has looked for quite some time, equities are a bit of a high wire act, and it looks like they're late in the cycle. I would not say people don't buy equities, but what I would say is that if you are buying equities, you want to make sure you have a risk control discipline, a good exit strategy that is fully in place, so that you know exactly where you're going to get out, where your stop losses are going to be, because the equity market could kind of go either way. It could continue to go up, and so maybe there's a reason to participate. But if it doubles back, it could double back quickly and very hard and unexpectedly. And so, this is one time where I would say it's a good thing to review portfolios almost on a daily basis in terms of being able to successfully manage risk. And we can leave it at that. Our view forward is basically constructive. We see a lot of opportunity to continue to make money for our clients and continue to meet our goals while at the same time always keeping a risk mitigation strategy in place. If anybody has any questions, I'd be happy to take a few questions. I'm going to pause for just a second. Alrighty. It just turns out that so far we have not had any questions. I will say if any of you do have questions, I want to follow up with me in some way, my email is frank@sierrainvestment.com. Investment with a T, no S. Please feel free to email me, and we look forward to keeping in touch with all of you. Thank you so much for all your time. Appreciate it.